Now presently we are focusing on to one of the standard AS5. Like AS4, this is also a very significant accounting standard that comes either in accounts or in audit. So that way the standard has got lot of relevance in group 2. Let us now take up the standard. The standard does not going to quantify anything. It doesn't have any recognition criteria like AS4 only. AS4 actually discuss what? Whether an event that happened after the balance sheet, is it adjustable? Non-adjustable in the balance sheet. Understood? Something happened after balance sheet. That was the primary discussion we had through AS4. Now AS5 is not connected closely to AS4 and all, may have some link, but primarily it is presentation of incomes and expenses in the P&L. Before the Schedule 6, now which is called as Schedule 3, the Companies Act 2013. Before that there was no format for presenting P&L. There was format for balance sheet, but there was no format for P&L. So P&L can be in any form and in any order, any heads, that is according to the wishes of the enterprise, the management or the accountants. There was no proper form. Now at least for companies now there is a form. So before that some regulations was there in P&L only through AS5. AS5 required the incomes and expenses to be arranged in these groups at least. Understood? So it is just grouping of income and expenses in the P&L. In balance sheet we have specific groups called current, non-current, assets, liabilities. That way we have specific groups. Under current, non-current, specific groups, subgroups. Now such group was not there for P&L. Now we have some minimum grouping made by this AS5. So AS5 primarily dealing with what? Presentation and disclosure requirements of items, incomes and expenses in the statement of P&L. Understood? So the title of the standard is what? Net profit or loss for the period, prior period items and changes in accounting policies. Understood? So which means it is as if it covers three aspects of P&L: current period profit or loss, prior period item and change in accounting policy. But if you see that particular standard, it actually covers 5 presentation. Shall we? What are those 5 presentation it is making? So let us now discuss about. So this AS5 title may cover only 3 aspects. The content is actually having 5 items. AS5 Panchtantra. Now listen. Now please listen. Kamala Hassan movie. So what are those items covered? It is ordinary activities, profit or loss from ordinary activities. Then we have extraordinary items. Because we don't call that, mention that as ordinary items. It is profit or loss from ordinary activities. Extraordinary items, prior period items, changes in accounting, estimates. No, every time you are requiring items are recorded. Changes in accounting policies. If you are so fond of Raj, you can perform an item song in farewell. Raj will be exactly fit for that. Anyway, please. Understand? Ordinary activities, profit or loss from ordinary activities, extraordinary items, prior period items, changes in accounting estimates and changes in accounting policies. Everybody? Listen friends. Let us discuss about what they are and what is the disclosure requirements. Presentation and disclosure requirements. Everybody? Ordinary activities. So when we say profit or loss arising from ordinary activities, what we need to know is only ordinary activities. Activities that are undertaken by the enterprise as part of its normal business activities. And includes incidental activities. So normally in a layman's understanding, the activities that arises in the normal course of business activities. That is what understood as those activity undertaken by the business enterprise as part of its normal business activity, and it also includes incidental activities. Incidental to the normal business activity is also to be considered as ordinary activities. Everybody? Then we have extraordinary items. Refers to incomes and expense that arise from events or transactions that are clearly distinct from ordinary activities and thereby not expected to recur or occur regularly. Extraordinary items normally gets the nature of non-recurring item. But does it mean that all non-recurring items are extraordinary items? Extraordinary items are normally non-recurring items. Could you appreciate the discussion? But just because I make mention like that, immediately you should not understand that all non-recurring items are recurring. That does not come again and again. Understood? That does not occur regularly. Everybody? That is what we are understanding that way. So it is the income or expense that arise from events and transactions that are clearly distinguishable from ordinary activities. So we have ordinary activities and extraordinary activities. Shall we proceed, friends? Now listen. Salaries paid. Is it an ordinary item or extraordinary item? Ordinary items. Correct? Rent paid. Electricity paid. Bonus paid to the employees. Ordinary items. It does arise in the normal course of business activity. You can't tell, it is clearly distinct from the business activity. It is an incidental activity of the business that paying bonus to the employee, 1 month salary, 25 days salary, like that you are paying bonus, is not considered as an extraordinary activity. It should be clearly distinguishable from the normal activity. In other words, it does not arise in the normal business activity. Something which will never be visualized in a business activity is what we call it as extraordinary activity. Could you appreciate that? Respond. So we have purchases, sales, okay, interest paid, interest received, Interest received from long-term investments. Ordinary item. So because why we are mentioning this now? In cash flow statement, interest received is investing and interest paid is financing activity. Are you following? And those item comes in the P&L. Everybody? So even though such item comes in the P&L, you should not feel that, sir, only operational transactions are ordinary items. If it is investing and financing, not ordinary, you should not tell. Yes. Everybody? Loss on sale of machinery. Loss on sale of a machinery is ordinary items. Loss on sale of machinery is also ordinary items. Could you appreciate that? See, buying an asset is an ordinary activity of a business. Everybody, usage of the machinery. After using the machinery is getting disposed. Can you tell it is never arising in the business activity? Please respond, friend. So from that sale, you will get some surplus or deficiency, which is booked as profit or loss. Is naturally ordinary activity only. Understood? So profit from sale of machinery, ordinary. Loss on sale of investment, profit on sale of investment. All these things are ordinary only. What is extraordinary? So loss by fire accident, loss of stock by fire accident, extraordinary item. Understood? So you can't tell that those items are ordinary item because we should not tell that, sir, you told business means asset will be there. Asset is there, it will be sold. Like that, you told. Similarly, business na fire will come. Fire na loss will come. So thereby it is ordinary, you should not convey. Could you appreciate that? Everybody. Loss by theft. Extraordinary items. Are you following this? So thereby we just understand that. Sure. Friends, listen, please settle down. So thereby we understand that. Chuma. So extraordinary items refers to those income and expense that does not arise or that does not relate to the normal business activities. Okay. We have ordinary activities, extraordinary activities. Everybody? Loss by theft, what do we say? Loss by employees theft, petty employees theft. Extraordinary. You should not tell that, sir, employees only, our own employees. Sir. Whether it is theft by third parties or theft by our own employees, still it is considered as extraordinary items only. Understood? Extraordinary expense only. Could you appreciate that? Everybody? Okay. Like you have extraordinary expense, you may also have extraordinary income. Understood? A compensation received because of an earthquake. Extraordinary income. Could you appreciate that? So similarly, any other compensation received in relation to a suit filed against a competitor. Extraordinary income. Could you appreciate that? So that way, now you could distinguish ordinary and extraordinary. Are you following this? So that way, please understand the primary distinction is made ordinary and extraordinary because the P&L will have income and expense clearly distinguishable into the ordinary items as well as extraordinary items. Right? Now proceeding further. Prior period item. Understood? So here, example, loss by fire, theft, compensation received, compensation paid either because of voluntary retirement or maybe because of the retrenchment made. Because of that you are paying some compensation. So such things and all will be considered as extraordinary items. Understood? Now proceeding further. Can I turn this page? Hey. No teasing. Good bro, good people. Don't tease. Who said? This is not good. That depends upon contract. Friends, please settle down. Friends, be quiet, please. Okay. We have prior period items. Refers to income or expenses that arise in the current period on account of error or omission in prior periods. Refers to income or expenses that arise in the current period on account of errors or omission in the prior periods is what we understand as prior period items. Are you following this? So what a prior period means, this year some income is arising. This income is not relating to current year. It relates to prior period. And it is arising the current year because of error or omission in prior period. Then it is called a prior period expense or prior period incomes. Do you appreciate that? So we have these two items, whether ordinary or current year profit or loss items. Understood? But this item is actually relating to previous year, arising in the current period. Everybody? Fine. What happened is that last year we purchased a machinery for 10 lakhs. Machinery for 10 lakhs. Depreciation at the rate of 12%. Depreciation at the rate of 12%. So what is the depreciation? 1,20,000. Understood? They charged depreciation only 12,000. They charged only 12,000 because of some technical mistake. Imagine the depreciation instead of 1,20,000, they charged depreciation only to the extent of 12,000 rupees. Now during the current year, another 1,20,000 is chargeable for the second year. Now only we notice that, oh, this year 120, how come previous year 12,000, when we compared, we understood there was a mistake happened. So that 1,08,000 also will be charged in this year only. We can't change the P&L account of previous year. Understood? So in that case, we will be charging totally depreciation of 2,28,000 in the current year. Do you understand the discussion, my dear friends? So 1,20,000 in this current year and 1,08,000 of previous year in this current year. Totally 2,28,000 will be charged. In this 1,20,000 is a normal current year depreciation. 1,08,000 should be shown under the head prior period expense. Because it is an expense arising in the current year. It is arising in the current year on account of error in the previous year. Suppose the depreciation was not charged. Depreciation was then also in the year it will be coming as prior period because it is considered as an omission. Understood? So thereby any income or expense arising in the on account of omission in the prior period is what we call it as prior period items. Understood, friends? Everybody? Okay, so this is what we understand as prior period item. Now imagine there was a theft that happened in the previous year. There was a theft that had happened in the previous year. Some loss was there, maybe some 420 events, or maybe real theft, cash has been stolen, or it could be some forgery that had happened. Everybody? Correct. So something had occurred in the prior year which was not discovered in the previous year. Which was not discovered in the current year. When we are scrutinizing accounts for one more time internally, auditors never found out. Internally when we are scrutinizing the accounts, we discovered the error actually not relating to previous year. Not relating to current year, it is relating to previous year. So we have to book that loss in the current year. Why should you book the loss in the current year, sir? Because previous year is over. I can't now change the previous year P&L. That is not at all allowed. Once the accounts are adopted, even if you discover some income or expense in the next year, respond, after the approval of accounts, you notice some income or expense relating to previous year. Now I can't change the previous year. I have to book that in the current year. It has to be disclosed. Understood? So under what head it has to be disclosed is a discussion. So is it current year loss or is it prior period loss? Is it current year item or prior period item? Why it is prior period? Anything relates to previous year, thereby it is prior period. Relates to previous year, thereby it is prior period. In the current year, what I should be showing? It's a current year loss or prior period loss? Should be shown as a prior period loss because it is arising as an omission in the previous year. It was omitted to be accounted. But then the question arises, sir, I omitted because I don't know. Your awareness is actually not a consideration for accounts. Please respond. That loss was there in the... Your awareness is not at all a consideration. For example, that loss was discovered in the previous year itself. Or this loss was discovered in the current year prior to the approval of accounts. Prior to the approval of accounts. Understood? Respond. The loss was discovered in the relating to before the approval of accounts of the previous year. In that case, is it adjustable event or non-adjustable event? It is because you believe that the condition of loss was there in the previous year. So whether you are aware of or not aware of is not a consideration. Correct, Appa? That's a point here also. So it's an omission in the previous year. It has to be accounted in the current year as a prior period loss. Please respond. We transported goods through the railway. Everybody? Some goods were stolen or lost or destroyed. So we lodged the complaint with the railways and asking for compensation. Everybody? Loss was already booked in the previous year. And the amount we are just claiming from the railway was not booked as revenue in the previous year. Not from insurance, from the railway. Understood? So we are asking the compensation from the railways. Because of their mistake only this loss had happened. So we have just made that claim. So that claim is not recognized as revenue in the previous year. Please respond, friends. Now what happened? The next year, railways accepted their mistake and gave compensation to us. Railways accepting the mistake and gave. We got the income. Response. This income will be shown as what? It is actually relating to which year? Previous year. It is not relating to current year. It is the loss relating to the goods were not lost in the current year. The goods actually lost in the previous year. Understood? So they are giving the amount relating to previous year loss. I will be booking as what item? Current year item. Because it is not error or, sir, omission. No, you didn't account in the previous. I should not have accounted this. I should not have accounted that. Understood? When the claim was made, lodged with the railways, I should not have accounted. Correct? The omission is the correct accounting made in the previous year. Respond. And now in the current year I got the revenue. I will book it as current year revenue only. Could you appreciate that? That will not be booked as? Why I gave this example? Na? Anything that relates to comes in the need not be prior period. So it has to be relating to previous year, arising in the current year on account of error or omission in the previous year. The significance is given, the stress is given to the words, it is arising because of error or omission. Sir, relates to previous year, coming in the current year. Understood? Respond. Say we will be discussing, the next item is called changes in accounting estimates. Changes in accounting estimates. For example, what happens? It is not change in accounting estimate. This example is like this. Arrears salary paid. Arrears salary paid. Understood? What is arrears salary? Suddenly when the salary scheme is devised by the government based on the various pay commission, everybody, now they are revising the salary not on a prospective basis but on retrospective basis, and thereby this arrears comes. Understood? So this arrears salary when it is paid, now what happened in 2014 to 15, we are paying some portion of salary of 12-13, some portion of salary of 13-14, and some portion of, full portion of 14-15. We are paying in the year 14-15. Everybody, in the year 14-15 we are paying salary of 12-13, 13-14 and full 14-15. Now this 12-13 and 13-14 salary what I am paying relating to in the should be shown as current year item only. That is not prior period. Even that is relating to prior period. Because it is not arising in the current year because of error or omission. It is not merely awareness that salary was non-existing on that day. It was now only made with a retrospective effect. So it has to be. So thereby don't get confused. Anything related to previous year coming in the current year, prior period. No. It has to be arising in the current year on account of error or omission. In a definite question, sir, in every examination, either in accounts or auditing, relating to prior period item. Not in the entire standard, at least prior period item. Most of the times, repeatedly tested area. Somehow a case law will be connected to prior period item. Understood? So thereby it should be very clear. An income or expense arising in the current period on account of error or omission in the prior period is what we call it as prior period items, incomes and expenses. Understood? Akka? Yes, shall we? Okay, friends. Loss by theft of current year, in the current year? Extraordinary item. Loss by theft of previous year, discount in the current year? Prior period item. Under prior period, ordinary or extraordinary? There is nothing like that. Understood? Under prior period only. Understood? Only the current year profit or loss will be classified into ordinary and extraordinary. Under prior period, again you don't have classification of ordinary, extraordinary. Understood? For P&L now have got three groups. What are the three groups? Ordinary, extraordinary, prior period. So that is how we show our P&L when I discussed as per the schedule 3. Profit or loss before extraordinary and prior period. In fact, there the company's format does not give separate significance for prior period items. They give exceptional items and extraordinary items. Let me bring that exceptional item later. Right, following this, we have ordinary, extraordinary, prior period. Now the next item is what? Changes in accounting estimates. What is primarily accounting estimate? income or expense that are determined or measured by using judgment is what we call it as accounting estimate. Accounting estimate primarily refers to any income or expense that are determined or it is measured by using judgment is what we call primarily as accounting estimate. In the accounts, we are not actually going to discuss about accounting estimate, we are going to discuss about change in accounting estimate. Understood? So what is accounting estimate? Anything that is measured by judgment is depreciation in the P&L is an accounting estimate. Are you following this? So measuring the investment loss or most of the provisions, provision for warranty, provision for that, this, every bad debts, every such provision, everybody, so will be considered as what? Estimates. Reserve is not part of P&L. Provision is a part of P&L. Understood? So thereby, lots of accounting estimates will be made. In other words, so many incomes and expenses are recognized purely by estimate. How to estimate all these things doesn't convey through the standard. We are actually going to discuss about. So thereby, what is change in accounting estimate? If in the subsequent period, if the estimate amount is changes, then it is referred as changes in accounting estimates. If the estimated amount of income or expense changes subsequently, it is called change in accounting estimate. We predicted the provision for bad debts, which means the bad debts to occur in the next year, relating to current year. First of all, you should know provision for bad debts is actually not relating to next year. It's a loss for the estimated and provided for. Understood? So it's a loss for the current year, estimated and current year making sales. Current year only we have shown the data in the balance sheet. This data turning bad is what we are projecting as provision for bad debts. It is not that whatever sales will be made in the next year, from there how much bad debts will come? Never. It is from the current year data, a percentage is expressed as provision. So people might understand provision for future losses. No. Are you following? It is for the known losses of the current you create provision. Could you appreciate that? So that way you have provision for bad debts estimated and you have provided for none. And you provided 5,000. Actual bad debts comes to 7,000. So there is an extra loss of, that extra loss of 2,000 is called change in accounting estimate. That extra 2,000 loss will be considered as change in accounting estimate. Could you appreciate that? So the 5,000 what you made is an accounting estimate. Now we are not discussing about the presentation of accounting estimate. We are discussing about accounting estimate will come under either ordinary or extraordinary. Now we are discussing about changes in accounting estimate. So now what happened? In this year we estimated the bad debts will come to 5,000. That is out of this data which is expected to be collected in the, from that data some 5,000 will become bad in the next year. But the loss is relating to, because revenue was booked in the current year. We appreciate that. Now comes to the second year. My dear friend, listen. Focusing on eating later. Now listen to the accounting standard. Very important. We find that in this year, second year, we find the bad debts loss comes to 7,000. There is an incremental loss of 2,000. There is an incremental loss of 2,000. My dear friend, no sleeping. Absolutely no sleeping. Your friend there behind, hiding and still, I don't know, writing or sleeping up. Now he's awake. Okay, it's you. Not allowed, my dear friend. Please don't sleep. Please try to listen to the class. Sleeping at night only. Night don't do any other work. Now listen. Red shirt. Accounting estimate. Overnight study பண்ண வேண்டாம்னு சொன்னேன். Accounting estimate refers to income or expense that are determined using, that are measured, determined using judgment. Understood? Now we are discussing about change in accounting estimate. Understood? So when it's estimate that changes subsequently is known as changes in accounting estimate to be separately presented in the financial P&L account, statement of P&L, not as prior period item. Why this was brought into the standard? Now, because if these are the only items that has been conveyed by the standard, this will also be fitted into prior period item. Because you feel that, sir, provision was created for 5,000, actual bad debts comes to 7,000, error, sir. That is a mathematical error. I'm sorry. That is a judgmental error, not mathematical error. Mathematical error will come as prior period item. Judgmental error. Judgmental error cannot be taken as prior period item. Could you appreciate that? So thereby, what the standard says now, any change in the accounting estimate has to be separately presented, not to be presented along with prior period item. Change in accounting estimate has to be separately presented. Separate disclosure. Change in estimate, separate disclosure, and not as prior period item. There was a fire accident that happened on March 31st in our premise. Some loss was estimated and you booked the loss and accounts are all approved. After 3-4 months only you understand the actual loss is not that, it is slightly increased. So that loss relating to the fire is booked in the current year. Everybody, so it should be booked as current year item only, not as prior period. In current year item, it should immediately come as ordinary or extraordinary. It should come as ordinary or extraordinary. So the change in accounting estimate will be shown as part of current year profit or loss. Change in accounting estimate will be shown as part of current year profit or loss, even though such an item is relating to previous year. It is forming part of current year items only. Correct? Is it shown as ordinary or extraordinary? My dear friend, now you are talking. First you are sleeping, now you are talking. The second time. Anyway, so we are just proceeding further. Don't say it is, don't come for argument. When I noticed only with the two friends, some communications happening. Something is happening. Some communication is happening, then I am just telling. So they don't immediately come. Don't say, no sir, I didn't show any reaction. I was focusing here only. Then am I fool? So please don't do that. Then I can show that picture, what you are actually doing there. Understood? Listen. Change in accounting estimate. What is required is here? Separate disclosure. Okay, so others nearby them, don't irritate them. Okay, now what you will do is, please don't do that, that will hurt them, right? Now listen friends, that is the fundamental basic character of any student when I was there. And I used to do all sort of tricks you may not be doing, but because of the guilt feeling only I am telling all these things. Don't do that nonsense. Anyway, we just find out change in accounting estimate. Understood? So change in accounting estimate should be separately disclosed, not as a, it should be disclosed as part of current year profit or loss. Now, is it to be classified as ordinary or extraordinary depends upon the original estimate. If the original estimate in the prior period, in the previous period was, then change in accounting estimate is also ordinary. If the original estimate is extraordinary, then change is also extraordinary. For example, provision for bad debts, when the provision was made, it was change in provision is also ordinary. But when the provision for loss by fire is made, it was thereby change is also extraordinary. Understood? One thing is that it is not to be shown as prior period. Understood? Now we have the last item called change in accounting policy. So any judgmental error, any changes in the provision, shall not be considered as prior period. Judgmental errors is not error. So here we consider this error or omission only dash error, accounting error, mathematical error, not judgmental error. Understood? Abba? We expected this much loss only. That came not correct. So because of the additional loss comes not prior period. Changes in accounting estimate in the current year only you will provide. Is that clear, friends? Yes, sir. Now listen. Suppose a fire accident took place on March 31st. A fire accident took place on You didn't account any loss in that year because the measurement and all took time, the survey and all took late. So actual loss was known and actual loss was provided. Actual loss was provided only on the next year. It is to be recorded as prior period. You didn't book any loss because of fire. You book the entire loss only in the next year. Everybody, it is a omission that has been made. Correct, Abba? You estimated some amount of loss. This is what you believe that as loss. In the subsequent year, it is either increased or decreased. Then it is change in accounting estimate. Same things only, same item. Some extra losses booked, understood? So the total loss, imagine 50 lakhs. I put it quantified. And in the first year, we booked a loss of 30 lakhs. First year, we booked a loss of believing that it was 30 lakhs. In subsequent, the loss was increased. Then it is change in accounting estimate. Only through good audit, you can very clearly distinguish, is it an error or is it error or is it change in accounting estimate? Understood? Because don't come and ask immediately after the discussion, sir, how do I know? So for that you should be a very, very shrewd auditor. Understood? So you should be analyzing whether it is making common sense or not. Telling that 30 lakhs suddenly becoming 50. Because sometimes the management will play. So such a big amount of loss coming in this P&L immediately will affect our image. So we will like to distribute the loss to 2 years. And in the next year, they will book it as current year loss only. They don't want to book it as prior period loss. Understood? So they don't want to immediately say it is a loss of previous year and all. Understanding? So what they will tell is that we estimated the amount as only 25. Suddenly loss came to 50. Understood? See, the estimation will go this much wavered. It is 100% change in the estimation and all may not be accepted. Sometimes it is acceptable, sometimes not. It's a fact, circumstances which will decide, with your evidence, which will decide whether it is error or change in accounting estimate. Would you appreciate that? So that is now become highly practical. Shall we proceed? Now here, if it is judgmental error, additional loss comes in this year because of previous year. Change in accounting estimate. An accounting error, mathematical error, because of that I am getting some loss related to previous year. Prior period item. That's the difference. Is that clear, friends? Change in accounting policy. Change in accounting policy. Policies. Changes in accounting policies. See, this is something very elementary what you have learned in AS1 only, which is once again covered through AS5. First of all, when a change is allowed, as per AS1, accounting policy refers to what? Disclosure of accounting policy. Accounting policy refers to accounting principles and methods adopted in achieving such principles. When an accounting policy can be changed? Okay. When an accounting policy can be changed? Say accounting policy. When accounting policy can be changed, first of all. Everybody complying with statutory requirements. Understood? Complying with statutory requirements. Complying with accounting standards. The third only we have for better presentation of financial statements. When accounting policy can be changed, comply with statutory requirements. Suddenly Companies Act or maybe some other act requires you to do like this only. Henceforth, SLM shall be fully prohibited. You have to follow only WDV. Then those who were following SLM, now converting into WDV, everybody is very much allowed. Or complying with accounting standard. Suddenly accounting standard says that henceforth LIFO not possible, only FIFO possible or FIFO unweighted average possible. You were following LIFO all these years. Then you change the accounting policy. Understood? For compliance with accounting standard. You yourself believe that this, based on the present business setup, this will provide better information to the readers. Understood? So in that case, it will be considered as, that is a cause for change in accounting policy. Understood? So when a policy is changed, now let us go to the disclosure requirements. We have just initially understood what is an accounting policy, when it can be changed. Understood? So now disclosure requirements. Disclosure requirements. First, profit or loss from ordinary activities. Profit or loss from ordinary activities. No specific disclosure required. But if the nature and size of income or expense is such that if disclosed provides better information, then it shall be separately disclosed. That is exceptional items. Which means exceptional items are only ordinary items. But sometimes the disclosure, if made, we believe that it will provide better information, then disclose it. For example, loss on sale of machinery. Loss on sale of, you got around 20 lakhs because of loss on sale of machinery. Everybody. So this loss on sale of machinery is an ordinary item or extraordinary item? It's an ordinary item. But a reader will appreciate much better if you show this in a separate presentation, that highlighting that, correct? So that the reader can easily understand the nature and the impact of such items on the P&L, correct? Please respond, friends. So we know that such loss is not going to happen regularly. Arrears of salaries, arrears of wages are all current year items only. Respond. Previous year salary paid in the current year, based on that arrears concept, it is current year item only, current year ordinary items only. But if you can disclose that, reader can easily separate such item to know the real impact of current year profit or loss. Because they know that this is one of such item, it is not actually relating to current year. Understood, Appa? So thereby, if certain items you believe that if disclosed provide better information, you should disclose. Such items are called exceptional items. Are you following? So you valuing the stock at NRV, because of that you are getting a loss. That loss has to be separately disclosed. Now valuing the stock at NRV is ordinary or extraordinary? Ordinary. Market fluctuation happens, suddenly you are valuing the stock at NRV is an ordinary item only. But you need to disclose it because it provides better information to the readers. Understood? So that way we find that for ordinary activities no specific disclosure is required. Understood? Everybody? Now, for all other items, extraordinary items, should be disclosed as part of current year profit or loss. The nature and amount of such items shall be disclosed in the P&L in such a way that its impact can be perceived. Impact can be perceived by the users. Extraordinary item should be disclosed as part of current year profit or loss, which means that is not to be shown as a separate item as if not relating to current year. The nature and amount of such item shall be disclosed in the P&L in such a way that its impact can be clearly perceived by the readers, can be clearly understandable to the readers. Understood? That is what the disclosure requirements relating to extraordinary items. Everybody? Can I turn this page? Extraordinary item should be disclosed as part of current year profit or loss is the first point. Which means that is not to be presented as if it is distinguishable from the current year item. It is part of current year items. Then the nature and amount of such item shall be disclosed in such a way that its impact can be clearly perceived by the readers. Understood? So next we have prior period items. Prior period item should be disclosed after the current year profit or loss. Prior period item should be disclosed. Prior period item should be disclosed after the current year profit or loss. Everybody, prior period item should be disclosed in a separate head after the profit or current year profit or loss. And then again, you should be disclosing the same only. The nature and amount of such item shall be disclosed in P&L in such a way that its impact can be perceived. Understood? So you will disclose in such a way that, so which means do you want to disclose that in a separate heading or sub heading? So in whatever way you disclose, so that the real impact can be understandable to the readers. Because of this prior period item, in what way the profit have reduced, in what way profit have increased. That impact that we can show, that is what required for prior period item disclosure. Understood? Nature of such item. Is it arising because of error or omission? How much is the amount of impact? All these things you should be disclosing. Correct? When we say nature and amount means the nature in what sense? What type of error, what type of omission, and how much impact in the current year P&L, that is what you should be disclosing. Understood? Similarly, extraordinary item, loss by fire, theft, everything has to be disclosed. Shall we? We have change in accounting. Change in accounting estimates. Will be disclosed as part of current year profit or loss. If original estimate is ordinary, then change is also change in estimate is also ordinary. If original estimate is extraordinary, then change in estimate is also extraordinary. Change in accounting estimate will be disclosed as part of current year profit or loss. If original estimate is ordinary, then change in estimate is also ordinary. If original estimate is extraordinary, then change in estimate is also extraordinary. Understood? Change in accounting policy. Change in accounting policy. The nature and amount of impact. The nature and amount of impact shall be disclosed if it is significant. If it is significant. The nature and amount of impact shall be disclosed if it is significant in the period in which change is made. In the period in which change is made. In the period in which change is made. But if change in accounting policy does not affect the current period, but already we used one but if the change does not affect the current period and affecting the first but venda, that is how the statement is not making, first but not required. If the change is not affecting the current period but affects the subsequent period, sometimes what happens, change is made in this year but it doesn't have any impact in the current year, it is affecting only in the subsequent period. Could you appreciate? So make that first, strike of the first bar. If the change does not affect the current period but affects the subsequent period, then disclosure is made in such subsequent period. Disclosure is made in such subsequent period. That's all. Understood? So these are the various disclosure requirements relating to changes in accounting policy. How questions that comes from AS5 we already discussed. They will give you one item, so they will discuss. They will ask you discuss in accordance with AS5. You will be disclosing first of all what is that provisions of the accounting standard, the case study, whatever come, that you will provide the analysis and you will provide a conclusion whether it is change in accounting estimate, prior period item or extraordinary item. Are you following this? Everybody. Suppose there was a fire loss happened in the current year. Fire loss happened in the current year. This was not accounted in the current year, it was accounted in the next year only. It was accounted in the current year with an estimated loss of 40 lakhs, but actual loss came to 50 lakhs. Change in accounting estimate. So it's the same item coming as extraordinary, prior period, change in accounting estimate. Everybody, are you following this? So please understand that there was a fire loss. In this year itself I am accounting it, pakka, then it is extraordinary. Sir, it was completely ignored in the current year. It was accounted only in the next year. In that year it will be accounted as prior period. No sir, we accounted the 80% of the loss. That is, whatever we believed as loss, we accounted. Suddenly additional loss arising in the next year. Change in accounting estimate. So you should be in a position of very clearly distinguishing these three components: extraordinary, prior period, and also those which are ordinary but are exceptional. Ordinary but extraordinary. Ordinary but exceptional, not extraordinary. For example, arrears of wages, huge amount of wages of 10 years, last 5 years salary, arrears paid in the current year. It's a huge salary paid in the current year. Is prior period or what? Change in accounting estimate? No, it is current year only you will be booking, but it is exceptional lah. Because that much salary it is charged in the current year, profit of current year will be diminishing. So if you can highlight that, then reader will appreciate better. So thereby that is called exceptional items. Could you appreciate that? So these are the various components of AS5. Understood? That way we are putting it into AS5.